Do you know what is actually sitting in your bank balance sheet right now? Because what I am seeing will make you pull your money out before December 31st. Institutions are hiding losses bigger than their entire capital base. Deposits vanish in silence while executives smile on CNBC. And in 7 days, when year-end numbers go public, the truth comes out, whether they like it or not. I have been investing for over 7 decades. I have seen market crashes, banking panics, and bubbles that made people millionaires on Tuesday and bankrupted them by Friday. And right now, as we approach the end of this year, I am seeing something that reminds me of the moments right before things went very, very wrong. Let me be clear about something first. I am not a doomsayer. I do not believe in running around with my hair on fire every time the market hiccups. Charlie and I, we have always said the stock market is a device for transferring money from the impatient to the patient. We believe in America. We believe in capitalism. We believe in holding good businesses for the long term. But there is a difference between normal market volatility and structural danger. There is a difference between a rough patch and an institution that is built on sand. And what I am about to share with you today is about that second category. Now, you might be wondering why December 31st matters so much, why that specific deadline. Here is what happens on that date. The curtain gets pulled back. Banks have to show their cards. Quarterly reports come due. Annual statements get filed. The makeup comes off, and you see what is really underneath. I have watched Berkshire Hathaway pull billions out of certain banks over the past 18 months, not because I think banking is dead, not because I have lost faith in the American economy, but because I know something most everyday investors do not spend enough time thinking about. Not all banks are created equal. And right now, some of them are standing on quicksand. You see, when you put your money in a bank, you are making a bet. You are betting that when you need that money back, it will be there. You are betting that the institution knows what it is doing. You are betting that the people running it understand risk better than you do. Sometimes that bet pays off. Sometimes it does not. Let me tell you what I learned back in 2008. I learned that when a bank goes down, it does not go down slowly. It does not send you a nice letter 6 months in advance. No, it happens fast, frighteningly fast. One day everything looks fine. The next day there is a line around the block and your money is frozen. I remember talking to a woman in Omaha after one of the regional bank failures. Smart woman, worked as a teacher for 30 years, saved diligently, had about $400,000 in certificates of deposit at a bank that looked solid on paper. When that bank went under, she spent 6 months not knowing if she would get her full life savings back. She was over the FDIC insurance limit on some accounts. The stress, she told me, took years off her life. That is what I want to help you avoid. Now, I know what you are thinking. Warren, you are a billionaire. What do you know about my problems? And you are right. But here is the thing. The principles that keep my money safe are the exact same principles that will keep your money safe. It is not about how much you have. It is about understanding where the real risks are and having the temperament to act on what you know before the crowd figures it out. Over the next few minutes, I am going to walk you through exactly what I am seeing right now in the banking system. I am going to show you the warning signs that professional investors look for. I am going to tell you stories from past crises so you understand how this movie ends. And most importantly, I am going to give you a clear, actionable framework for protecting yourself. This is not about panic. This is about preparation. You understand there are banks out there right now that are sitting on enormous unrealized losses. Losses they do not have to report clearly until year end. There are institutions that have made bets on commercial real estate at precisely the wrong time. There are banks whose deposit base has been quietly eroding month after month, and they are covering it up by borrowing from the Federal Reserve at rates that are eating them alive from the inside. And here is the part that should concern you. Some of these banks look perfectly fine if you just glance at their stock price or read their press releases. They have got fancy buildings. They sponsor local sports teams. They've been around for 50 years. They look stable. But stability is an illusion when the foundation is cracked. In a minute, I am going to pull back that curtain and show you exactly what is happening beneath the surface. I am going to explain why this particular moment in time is more dangerous than most people realize, and why the next few weeks matter more than the last few months. But first, you need to understand something fundamental about how banks actually work. Because I guarantee you, most people do not really know. And if you do not understand how the machine works, you cannot possibly know when it is about to break down. Let me start with a simple question. When you deposit money in a bank, where does it go? Most people think it sits in a vault somewhere with their name on it. But that is not how it works. The moment you hand that money to a bank, they turn around and do something with it. They lend it out. They invest it. They use it to make more money. That is the business model. Now, in normal times, this works just fine. You deposit $100, they lend out 90 of it, keep 10 in reserve, money flows in, money flows out. It is like a river. But what happens when everyone wants their money back at the same time? What happens when that river runs dry? That is what we call a bank run. And it is the oldest nightmare in banking. But here is what most people do not understand. You do not need an old-fashioned bank run anymore with people lined up outside in the cold. In 2025, a bank run happens at the speed of a phone app. You can drain an institution in hours, not days. Let me tell you what I am seeing right now that concerns me. First, interest rates. The Federal Reserve raised rates faster than it has in 40 years. Now, you might think that is good, Warren. My savings account finally pays something, and you are right about that part. But here is the other side of that coin. Banks, especially smaller and mid-sized banks, loaded up on bonds and mortgage-backed securities back in 2020 and 2021 when rates were at zero. They thought they were being conservative. Safe government-backed securities cannot lose, right? Wrong. When interest rates go up, the value of those old bonds goes down. It is just math. If you are holding a bond that pays 2% and new bonds are paying 5%, nobody wants your 2% bond unless you sell it at a discount, a big discount. Banks do not have to recognize those losses on their books as long as they plan to hold those bonds to maturity. They can call them held to maturity securities and pretend everything is fine. But the losses are real. The money is gone. It is just hiding in an accounting category. I have looked at the numbers. There are banks out there sitting on unrealized losses that are larger than their entire capital base. Think about that. If they had to sell those securities today to meet withdrawals, they would be insolvent, completely wiped out. Second problem, commercial real estate. You know this one if you have driven through any major city lately. Empty office buildings, for lease signs everywhere. The world changed during the pandemic. People work from home now. Companies do not need the same office space they used to. Banks lent enormous amounts of money against those office buildings. They made those loans when buildings were 95% occupied and valued at sky-high prices. Now occupancy is down to 50% in some cities, and those property values have fallen off a cliff. Here is how this hurts. When those loans come due for refinancing, the property owner cannot get a new loan for the same amount because the building is not worth what it used to be. So either the owner has to come up with cash to pay down the loan, or they default, and a lot of owners do not have that cash. Third issue, deposits. Banks are bleeding deposits. When interest rates were zero, people kept money in checking accounts because there was nowhere better to put it. Now you can get 5% in a money market fund. So people are moving money out of banks and into these funds. That sounds small, but it is deadly. Banks use deposits to fund their lending. When deposits leave, they have to either shrink their loan book, which kills their profit, or they have to borrow money to replace those deposits. And borrowing costs them more than deposits did. Some banks are borrowing from the Federal Reserve through emergency programs. They are paying high rates to borrow money they used to get for almost nothing. That is not sustainable. It is like using a credit card to pay your mortgage. You can do it for a while, but eventually the math catches up with you. Now, here is the part that connects all three of these problems. Liquidity. In banking, liquidity means having cash or assets you can quickly turn into cash. It is the difference between being broke and being illiquid. Banks are becoming illiquid. They have got assets, sure, but those assets are tied up in bonds. They cannot sell without taking huge losses, and loans they cannot call in without admitting those loans are bad. When depositors start getting nervous and moving money out, even good banks can find themselves in trouble fast, because banking is built on confidence. The whole system runs on trust. You trust that when you want your money, it will be there. The moment that trust breaks, the game is over. I watched this happen with Silicon Valley Bank. Not a bad bank, really. They just made a bet on interest rates staying low. They were wrong. Depositors figured it out faster than the bank could react. And in 48 hours, the 16th largest bank in America was gone. You know what scared me most about that? It was not that one bank failed. Banks fail sometimes. That is capitalism. What scared me was how fast it happened in the digital age and how close we came to it spreading to other institutions. December 31st matters because that is when the annual reports come due. That is when banks have to give us their full picture. The numbers that come out in January, they are going to show reality. And reality, my friend, is going to be uglier than a lot of people expect. Some banks are going to show up with numbers that make investors and depositors ask hard questions. Questions like, how are you going to survive if rates stay high? Questions like, what happens when those commercial real estate loans start defaulting? Questions like, why should I keep my money here when I do not trust your balance sheet? And once those questions start getting asked out loud, once the confidence starts to crack, things can unravel very quickly. In the next part, I am going to show you exactly how that unraveling happens. I am going to explain how a problem at one bank becomes a crisis across the system and why it hits ordinary people hardest. Understanding the mechanics of failure is the first step to protecting yourself from it. You know, there is something most people get wrong about financial crises. They think these things happen to other people. To the reckless folks, to the gamblers who took too much risk, they think, I have got my money in a regular bank. I have got FDIC insurance. I am safe. And then they wake up one morning and discover their money is frozen, or their business cannot make payroll because their credit line got pulled, or their job disappears because their employer banked at the wrong place. Let me explain how the dominoes fall. It starts with one institution. Maybe it is a mid-sized regional bank that made too many commercial real estate loans. Their stock price starts dropping. Some analyst puts out a report questioning their liquidity. The report gets picked up on financial Twitter. Then CNBC runs a segment. Now, here is where human nature kicks in. Depositors at that bank start thinking, maybe I should move some money just to be safe. And that is rational. But when 10,000 depositors all have the same rational thought on the same day, the bank is done. The bank tries to meet those withdrawal requests. They sell their good assets first. But when they are forced to sell bonds at a loss to raise cash, those paper losses become real losses. Their capital shrinks. Regulators are watching this happen in real time. When a bank capital falls below certain levels, regulators have to step in. By the time the public hears about it on the evening news, the bank is already gone. Now, that is one bank. Here is how it spreads. Other banks that look anything like the failed bank, they start getting nervous depositors too. People think, if that bank failed, maybe mine could too. Better safe than sorry. Money starts moving. Not all at once, just a steady bleed. Meanwhile, what is happening to businesses? Let me paint you a picture. You own a small manufacturing company. You have a line of credit with your local bank for $2 million. You use that line to manage cash flow, buy inventory, and make payroll when customers are slow to pay. You have had this relationship for 15 years, never missed a payment. One Tuesday morning, you get a letter. Your bank trying to preserve capital because it is worried about its own survival, is cutting your credit line to $500,000, effective immediately. Now, you cannot buy the materials you need for orders you have already promised to customers. You cannot make payroll next week. Your business is profitable, but you need that liquidity to operate. What do? You start laying people off. Those people, they have got mortgages, car payments, kids in college. They cut their spending. The restaurants they used to eat at, the stores they shopped at, those businesses see revenue drop. More layoffs, more cuts. That is how a banking problem becomes an economic problem, becomes a personal problem for people who never took any risk at all. Let me tell you about something else that happens. The wealth effect. When banks start failing, the stock market notices. Financial stocks fall first, obviously. But then it spreads. Investors get worried about the whole economy. They sell. Markets drop. You might think, I do not own stocks, so it does not affect me. But your pension fund owns stocks. Your 401k owns stocks. Your neighbor, who was thinking about buying your house, has just dropped 20% in his portfolio, so he is not buying anymore. Here is another way this hits ordinary people that nobody talks about. The survivors get stronger and meaner. When the weak banks fail, the big banks that survive get bigger. They buy up the failed banks for pennies on the dollar, and then because there is less competition, they can charge more. Higher fees, higher interest rates on loans, lower interest rates on deposits. I have watched this movie before. After 2008, the big banks got bigger. Checking account fees went up. Overdraft fees went up. Try getting a small business loan from a mega bank. It is almost impossible. The local banks, the community banks, those were the ones that used to know your name. When they disappear, that local knowledge disappears. That relationship banking disappears. Now, let me address something I know you are thinking. Warren, what about FDIC insurance? Is not my money protected up to $250,000? Yes, it is, technically. But here is what that really means. If your bank fails on a Friday, by Monday morning, the FDIC will have arranged for another bank to take over your accounts, or they will mail you a check. Your money is safe, eventually. But eventually, it can be a problem. What if you have automatic payments that bounce during that weekend? What if you need to make payroll on Monday morning and you can not access your account? What if you have more than $250,000 in one institution because you are a small business owner? The psychological damage is real too. When people go through a bank failure, even if they get their money back, they lose trust. They pull back. They become conservative at exactly the wrong time. I saw this after 2008. People who got burned in that crisis, many of them missed the entire recovery from 2009 to 2020 because they were too scared to invest. They kept everything in cash, earning nothing, while the market went up tenfold. Fear is expensive. Fear makes you poor. Not the rational kind of fear that makes you avoid stupid risks. The paralyzing kind of fear that makes you avoid all risks, including the smart ones. Here is the bottom line. When banks fail, the damage spreads far beyond the bank shareholders. It spreads to depositors, borrowers, employees, local economies, and the overall psychology of the market. The people who get hurt the worst are usually the ones who had no idea they were at risk. They did not study finance. They did not read the annual reports. They just trusted that the system would work because it always had before. And preparation, my friend, is the only real protection you have got. Let me take you back to 1929. Not because I was there, I am old, but not that old, but because my father lived through it, and he told me stories that shaped how I think about money. October 24th, 1929, Black Thursday. My father was working at a grocery store in Omaha. He said people came in that morning like normal. By afternoon, the whole mood had changed. Men were standing on street corners looking stunned. Some were crying. The stock market had crashed, and fortunes that people thought were solid had evaporated in hours. But here is what most people do not know about 1929. The real damage was not the stock market crash. It was what happened to the banks over the next 3 years. Between 1930 and 1933, over 9,000 banks failed. 9,000 people lost their life savings. Not because they had been gambling in stocks, but because they had done the most conservative thing possible. They had put their money in a bank. My father told me about a neighbor, a school teacher who had saved for 20 years, had about $3,000 in a local bank. The bank closed on a Tuesday morning. She never got her money back. She lost everything. What did that do to people? It made them terrified of banks for a generation. People buried cash in their backyards. They kept money in mattresses. That fear shaped behavior for 50 years. Now, let me jump forward to the savings and loan crisis of the 1980s. Over 1,000 institutions failed. It cost taxpayers over $100 billion to clean up. I remember visiting a friend in Texas in 1987. We passed block after block of empty office buildings, brand new buildings, beautiful architecture, completely empty. He called them see-throughs because you could see right through the windows to the other side. Those buildings had been financed by S&Ls that were now bankrupt. Here is what I learned from that crisis. Real estate lending is dangerous because everybody thinks local real estate always goes up. It does not. And when it goes down, it can go down a lot and stay down for a long time. Then came 2008. You remember this one? We all do. I will tell you what 2008 felt like from where I was sitting in September. I got a call from a friend who ran a large company. He said, Warren, we can not borrow money at any price. The commercial paper market is frozen. That same week, I got calls from executives at companies asking if Berkshire could loan them money because their banks had cut off their credit lines. These were not struggling companies. These were good businesses with strong balance sheets. But the financial system had seized up. The scary thing about 2008 was not just that banks failed, it was how close we came to the entire system collapsing. We were days, maybe hours, away from ATMs not working, from payroll systems shutting down, from grocery stores not being able to process credit cards. I made a decision during that crisis that I want you to understand. In October 2008, right in the middle of the panic, I invested $5 billion in Goldman Sachs. People thought I was crazy. I did it because I understood something. There is a difference between a liquidity crisis and a solvency crisis. Goldman had a liquidity problem. People were scared and pulling money out. But the business was fundamentally sound. Most people do not have that kind of information or that ability to time things perfectly. Most people were selling at the bottom because they were scared. They locked in their losses. Let me tell you about something more recent. March 2020, the COVID pandemic hit and the market dropped 34% in 5 weeks. Fastest crash in history. But I looked at what was happening and I saw something different than 2008. This was not a financial crisis. This was a temporary shutdown. Businesses were not broken. They were paused. The government and Federal Reserve moved faster than they ever had before. And within months, the market had recovered. By the end of 2020, we hit new highs. People who sold in March lost money. They will never get back. People who held on, or better yet, people who bought in March did very well. Now, why am I telling you all these stories? Because I want you to see the pattern. Every crisis feels unique when you are living through it. In 1987, it was portfolio insurance. In 2000, it was dot-com stocks. In 2008, it was subprime mortgages. Each time, people said, this time is different. And each time, the fundamentals were the same. People took too much risk. They used too much leverage. And when things turned, they had no margin of safety. But here's the other pattern. America recovered every single time. Not everybody recovered. Not the people who sold at the bottom. Not the people who had all their money in the institutions that failed. But the country recovered, the economy recovered, the market recovered. The question you have to ask yourself is, which side of history do you want to be on when this one plays out? Let me walk you through exactly how a banking crisis happens in the modern world. Not theory, not textbook stuff. The actual mechanics of how institutions die and how fast it happens. Day one starts quietly, too quietly. Maybe it is a Thursday afternoon. A bank, let us call it Regional Trust Bank, reports earnings. The numbers look okay on the surface, but buried in the footnotes, there is a problem. Unrealized losses on securities are bigger than last quarter. Deposits are down 8%. That evening, someone posts an analysis on social media. Regional Trust looks shaky. Deposit flight accelerating. Some investors who follow banking closely take note. Day two, Friday morning, Regional Trust stock opens down 6%. The bank puts out a statement. We have strong liquidity. Our capital position is solid. But now the financial press picks up the story. Bloomberg runs an article. Regional Trust faces questions about balance sheet strength. Here is where the modern world changes everything. 20 years ago, you would have to physically go to a bank branch to withdraw money. Today, you pull out your phone. You transfer $100,000 to JP Morgan in about 90 seconds. No line, no questions. By Friday afternoon, Regional Trust is seeing unusual withdrawal activity. Maybe 3% of deposits are going out the door. The bank treasury team is starting to get concerned. The weekend is when fear spreads. Saturday morning, a respected banking analyst writes a piece titled, "Why Regional Trust Could Be the Next Domino to Fall." It lays out the numbers clearly. The piece gets shared thousands of times. Regional Trust has branches in 6 states, maybe 300,000 deposit customers. A lot of them are checking this news over their Saturday morning coffee. They start calling each other. Did you see this about Regional Trust? Should we be worried? By Sunday afternoon, the bank executives are getting worried. They call the Federal Reserve. We are seeing significant outflows. We have liquidity to meet them, but if this continues on Monday, we may need to access emergency facilities. Monday morning, day 4. The bank opens with about $4 billion in readily available liquidity. By 10 a.m., they have seen $2 billion in withdrawal requests. By noon, $4 billion. By 2 p.m., $7 billion. This is it. The bank does not have $7 billion in liquid assets. They have to start selling securities at a loss. Those unrealized losses become real. They call the Fed. We need emergency borrowing. Now, the Fed provides it, but now they are borrowing at high rates to replace deposits that cost them almost nothing. The business model is broken. Monday evening, the stock is down 40%. Trading is halted multiple times. The bank puts out another statement about its strength and stability. Nobody believes it. Tuesday morning, day 5. The bank's largest business customers are panicking. A construction company with $5 million pulls everything. A car dealership moves its deposits. A regional grocery chain moves its payroll account. When the smart money runs, that is the signal everyone else is waiting for. By Tuesday afternoon, the regulators have seen enough. The bank has borrowed $15 billion from the Fed in 2 days. Their stock is down 65% from Thursday. The FDIC steps in. Trading in the stock is suspended. The bank is closed. Wednesday morning, the FDIC announces that Big National Bank is acquiring Regional Trust. Insured depositors are protected. Uninsured depositors will get most of their money back, maybe 90 cents on the dollar, but it might take time. Shareholders are wiped out. 5 days. That is how long it took from the first warning sign to complete collapse. Now, here is what happens next. There are maybe 30 other banks that have similar profiles to Regional Trust. Depositors at those banks just watch Regional Trust die in 5 days. What do you think they do? They do not wait to find out if their bank is strong or weak. They move money. And when they all move money at once, even strong banks can get into trouble. This is what we call contagion. One failure creates fear that creates more failures. It is not about fundamentals anymore. It is about psychology. I watched this happen in March 2023 with Silicon Valley Bank, Signature Bank, and First Republic. 3 banks gone in a matter of weeks. The fear spread to other regional banks. Here is what keeps me up at night. The next time this happens, will the government step in the same way? Can they? We already got massive debt. We already have political polarization. Will Congress approve another bailout? Will they do it fast enough? I do not know, and neither does anyone else. What I do know is this: the mechanics of how banks fail have not changed. The speed has just gotten faster. And the warning signs are all around us right now. You know, I have been asked 1,000 times over the years, Warren, what is your secret? How have you made so much money? What is the one thing people should know? And my answer always disappoints people because it is so simple. The secret is temperament, not intelligence, not education, no access to inside information, temperament. The ability to stay calm when everyone else is losing their minds. The ability to act when everyone else is frozen with fear. The ability to wait when everyone else is desperate to do something, anything. That is what separates the people who build wealth from the people who watch wealth slip through their fingers. Let me tell you what I hope happens after you finish watching this. I hope you take action. Not next week, not next month, this week. I hope you sit down, review your accounts, and make whatever changes you need to make to protect yourself. Because the time to fix your roof is when the sun is shining, not when it is raining. And then, after you have done that, I hope you relax. I hope you stop worrying. Because if you have been prudent, if you have been careful, if you have followed the rules we talked about, you are going to be fine. I am 95 years old. I have lived through 15 recessions. I've seen banks fail, stock markets crash, wars start, and pandemics spread. And you know what? America is still here. Capitalism is still here. Opportunity is still here. The people who have done well over the long run are not the people who never faced adversity. They are the people who faced adversity with clear heads and steady hands. They did not panic. They did not follow the crowd. They thought for themselves. They made rational decisions based on facts, not emotions. They had the temperament to stay the course when it was hard. That is what I want for you. Not just to survive whatever comes next, but to thrive, to come out the other side stronger and wiser and better positioned than you were before. You have spent almost an hour with me today. You have heard the warning. You have seen the risks. You understand what to do. Now it is up to you to act on it. Take care of yourself. Take care of your family. Be smart. Be prepared. And remember, in times of fear and uncertainty, the people who keep their heads while others are losing theirs, those are the people who win in the end. Thank you for watching. I hope this helps. And I hope when we look back on this moment a year from now, you will be glad you took the time to listen and act. Stay safe out there.
If you found this breakdown gripping, make sure to like, share, and subscribe. Your support keeps this channel soaring.